Alright, here we are. This video is going to explain everything you need to know about stock options. When to use them, how to use them, and yeah. So first, I just want to start with an example. Most people understand how housing prices appreciate. And believe it or not, there's actually such thing as real estate options, which I think are easier to understand. So there's two types of options, calls and puts. A call means you're willing to bet that the price will go up. A put means you're thinking the price will go down. So let's say I'm looking to buy a house in Wyoming, random state. And right now the house that I'm looking at is $500,000 listed. It's listed at $500,000. And I think that there's going to be a real estate boom in Wyoming. I would buy a call option at, say, $600,000 strike price. 2030 is the expiration. That's what I would pick. Okay? This means I would be willing to buy this house for $600,000 in 2030. Okay? Now, I would have to pay a premium for that to happen, because what if the house goes up to $1 million? And that is where the premiums come into play. And so, let's say I pay $20,000 to be able to buy this house at $600,000 in the year 2030. Okay, so that's all. I'm just betting on $100,000 gain in value in 4 years. If that price of the house goes above that $600,000, the option would be worth, it would be what we call in the money, which basically means it has intrinsic value. So if I were to sell that option again, it might be worth double to quadruple the amount that I bought it for. And so that's how I like to use options, is to buy and sell the call options and the put options. I don't like to use them to actually fill a position. There are people who can do that very well, but when you're trading stock options, you're not going to want to wait till the expiration date and let it fill. Okay, so that's the first example. And I think that kind of gives everyone a background on when to use options. We're going to get into stock options. And these are a lot more exciting than real estate options, because stock prices fluctuate 10 to 20% sometimes in one day. Very similar trading strategy. There's calls and puts, and you can buy and sell them. But each call and put contract is not worth just one share. It's 100 shares of the company. And so the option prices are determined by how expensive the stock price is. So if I look at a company like Target, let's go with Target as an example. Its price is right around $100 per share right now. And so if I wanted to buy a call option, I'll click right into it and actually just get the exact numbers for you. I'll buy a call option that is that has an expiration date of January 16th, 2026. So right at the beginning of 2026. If I were to buy a call option at the money, which means right at the stock price, it would be worth right around $700. So this means I'm using $700 to be able to use the leverage of 100 shares. But if I wanted to buy 100 shares of Target, that would be like $10,000. And so this is where you get the leverage utilization with options. Target stock was down 1.5% today. And so you take, let's say I owned 100 shares of Target. 1.5% of around $10,000. Well, let's see. That's like $150, okay? Now, I'm going to check the options price and what it went down today due to the fluctuation in Target's stock price, okay? It went down $70, okay? So, what does this mean? It means fluctuation in the options contract was less than the actual stock price. But remember I said the stock option at the money that expires in January cost $700 to buy. But it was down $70 today. So that's only about 1%, right? Compared to the 1.5 of Target, the stock price. And you don't have to spend $10,000 for the fluctuation of 100 shares of Target. Well, you might be thinking, why wouldn't everyone just trade options? Well, now we're going to get into the risk of buying options. Now, I'll go to a much shorter expiration date. Let's go to next weekend, okay? So about 5 trading days away. We'll go to the at the money call options, okay? We'll go right at the money, $97, okay? So, $97 strike price. Next week expiration, okay? So, as you might be able to guess, these are going to be a lot cheaper because who's going to want to pay a lot of money to place a bet that the stock price will go up in a week? It's not very likely. And even if some sort of news comes out about the company, the stock could drop 5%. And this is where the risk comes into play. If the option that you own reaches the expiration date, and the price is not in the money, that's where we get into expiring worthless, okay? So, let's say the stock price goes all the way up to $100, right? I bought this $97 strike price option. Target stock goes up to $100 by, let's say, next Wednesday. So 2 more days till expiration. That option that I bought probably went up 25% because it's $3 above the strike price, which means each share would be worth $3 above the strike price. That means it's worth $300, okay? And right now, the option that I bought is worth $130. So that's 100% that the option went up, even though the stock only went up $3. Okay? You catching my drift? Now, let's say the stock price drops right back down to 97 with 1 day left till expiration. Okay? That option contract price would go down to close to $0. And that's because no one would be willing to bet that it goes up above $100. Okay? The whole point of the people who hold the contract till expiration is to hold it so they can get as much above the strike price as possible to take advantage of filling shares under what the price is actually at. And if that doesn't make sense, just let me know and I can make another video trying to explain it, but that's my best explanation. That was an example of buying a call option. Now I'm going to describe buying a put option, okay? I'll find a different stock to talk about. This target's a little boring. Let's talk about NVIDIA, okay? Very popular stock. I'll go way out to the January 16th expiration, okay? NVIDIA is trading at $180, so 100 shares of NVIDIA would be worth $18,000, all right? But one call option for 100 shares worth of volatility is worth $1,800 right now, which means it's 10% of the cost for 100% of the fluctuation, okay? And that's kind of my best explanation for that. Okay, now let's go to next week. Let's go to $180 put option, okay? Let's say, so it's at $300, all right? Let's say I buy that put option for $300 today. Okay, I buy it for $300 and the stock price drops to $170. That would mean my option is $10 in the money, okay? That means my put option goes up in value. And I think that would go up in value, let's see, $10 times 100 shares. That's $1,000. So that would be worth $1,000. That's a 300% move, okay? And that 300% move only cost me $300 compared to buying 100 shares of the company short. Okay, selling 100 shares of the company, that would cost me $18,000 in capital. But with this option, I can buy it for $300 and have the possibility of it turning into $1,000. All right, that's another example of using options to ultra leverage your position. All right, now we're going to get into some more complicated option strategies: selling puts and selling calls. Selling call options first. Let's say I own 100 shares of a different company. Let's pick Uber. All right, that's also around $100 per share. So if I owned 100 shares of Uber, that's a lot of money. That's like $9,500, okay? I don't own 100 shares of Uber. This is just an example. Let's say I owned 100 shares. That gives me a lot of power to own 100 shares of a company because you're able to sell options contracts without having to cover your position with cash, okay? So 100 shares of your company gives you the power to sell a call option without having to cover it with cash. Remember that. That's why it's super advantageous to have 100 shares of a company in your portfolio. Now, you do not need 100 shares to sell a put, however, and I'll cover that a bit later, but let's talk about call options first. So, let's say my Uber shares are up 50% and I want to protect my position, okay? I would be willing to sell my Uber shares for $125 if it ever gets there, okay? January 16th, I can pick as the expiration date, okay? $125 is the strike price that I would pick, okay? Let me figure out how much I can sell that contract for. And then if the price goes up to 125 by the expiration, I would have to sell my shares, but someone bought a contract from me and I get to keep that money. Okay? So it looks like it's $150 for me to sell a call option on January 16th at 125 expiration or 125 strike price. So this gives me a lot of power because I don't have to worry about those shares anymore. But hear me out. If Uber's stock price went above $125, I would be missing out on all those gains because my shares would only count towards the 125. I don't know if that makes sense, but that's my best explanation. So when you're selling a call, you're basically capping your limit to your stocks that you own, but you take in money from someone else who bought it from you. So this is a good way to hedge your position. Let's say if you're expecting a company to report under expected earnings and you think the stock price will go down, it's a good idea to sell a call option and say, all right, if it does go up after earnings, I'm willing to sell it for this price. But if it goes down, I get to keep that money that someone else bought my option for. Okay, it's $150 that for this example. Okay? Now, let's get into selling put options because these, if you're really bullish on a company, these are a great way to gain more shares and not have to worry about when to buy. Let's talk about a different company here. Lululemon. They have a very expensive put options, okay? I'll go to that January 16th strike price, all right? And their stock price is right around $200 at the time of this video. Let's say I wanted to buy Lululemon shares on January 16th, okay? I could sell a put option. That means I'm willing to buy the stock at this price. Let's just say $175. I would be willing to buy it if it dropped down to that price. Right now, I could sell that option for $1,200, okay? That's how expensive those put options are. And if it goes down to that value by the time of expiration, I would be filled with those shares. So 175 times 100, that's $17,000. That's the thing about selling puts is you need the capital to be able to buy those shares if your option gets filled, okay? So it's super advantageous because if you're bullish, if you think the stock price will go up and you are okay with buying more shares, that's the way I think about it. Selling puts means I would be willing to buy the share if it dropped down to that price, okay? But if it never drops down to that price, you still get to keep the money that you sold that option for. So in this situation, it would be $1,200. $1,200 by January, that's a very good return. even though it's $25 out of the money, okay? So yeah, hopefully that helped explain stock options, and let me know if you'd like to get more in depth in any of those strategies, or if I can explain anything else in depth, any of the stuff I talked about more in depth. All right, let me know. Make sure to subscribe. I'll be dropping more videos like this, kind of the long form explanations. I might do deep dives into companies I'm invested in. So make sure to subscribe and like. And yeah, I'll see you in the next one.